Today, we want to talk about the efficient market hypothesis. So far, we have learned different stock valuation techniques. So now, let's assume that we have used these techniques very carefully and we have come up with an estimate for the Walmart stock price. The question is now what to do if the stock price that we estimated for Walmart is different from its current market price. So let's say that we estimated the Walmart shares to be worth 145, but Walmart shares are currently traded at $130. Should we trust our own stock valuation or should we trust the market values or market prices? The answer to this question is quite difficult, but I would say we should avoid overconfidence. Specifically in US capital markets or other developed stock markets, a publicly traded firm is monitored by many analysts. So the market price of a publicly traded company should already provide very accurate information regarding the true value of the asset that we are evaluating. Okay, what that means is that there are many professional market participants in US stock markets or other developed countries' stock markets. These analysts are constantly monitoring the value of the stocks. They issuing reports. The investors have access to these reports, and there are hedge fund managers, mutual fund managers, and other institutional investors who are constantly searching for new information to trade on. So what we see on the market as the stock price for publicly traded company should provide a very good estimate of the stock price. And we know that the valuation models that we have used have many assumptions. We need to make assumptions and we need to forecast cash flows. So those estimations are prone to errors as well. But of course, the market can be wrong as well sometimes. So people or investor in general can be very optimistic or become very pessimistic in certain times when news are flooding to the market. Okay, so sometimes the asset prices might become overvalued or sometimes might become undervalued. But in general, we expect that the market prices to provide a very good estimation of the true value of assets. So if you want to trade based on your own stock valuation, you should ask yourself, do you have any unique information, in any unique news or a superior information about the stock that you want to trade? So for example, you're a junior analyst, you're trying to figure out the business of a company, and you found a very unique information about the company. So at that specific time, if you ask yourself whether others have access to this new information or not, or whether your information has has added value to the market prices or not, you can then trade based on your information. But this is usually does not happen because, as I said, there are many professional market participants who are constantly competing to get the prices as soon as possible and trade on them. Okay, but the stock valuation techniques that we have learned about are not useless. We can use the market price to estimate other parameters that were in those stock valuation models. So now let's see this example to better understand what I mean by that. Suppose SWGSP Industries will pay a dividend this year of $6.50 per share. Its equity cost of capital is 11.5%, and you expect its dividend to grow at a rate of about 5% per year. Though you're somewhat unsure of the precise growth rate. If SWGSB's stock is currently trading for $63.32 per share, how would you update your belief about its dividend growth rate? So, first of all, notice that this sentence in the example, so you expect its dividend to grow at a rate of 5% per year. So you should immediately figure out that this is a constant growth dividend model, or the Gordon model. So the formula that we are going to use to evaluate or to come up with an estimate of this company would be P0 equal to dividend 1 divided by RE minus G. Okay. So now I have used this formula to come up with an estimate of the price for SWGSB. So based on my forecast of the growth rate, I come up with an value of $100 for SWGSB. However, its market price is only 63.32 cents. Okay, so this implies that investors expect dividends to grow at a much slower rate than 5%. So again, because this dividend it was something that we haven't forecasted, and then the cost of capital were pretty sure about it. So the only thing that we were unsure about it was the growth rate. So here we can use this formula to solve for G and come up with a better estimate of the growth rate for SWGSB, or this growth rate is what the market expect the dividends of SWGSB to grow at. Okay, so once we solve for G, we get 1.2%, which is much lower than 5%.